Hey everyone, happy Wednesday. This is Jamie Russo. I am multitasking again on Facebook and Instagram, so hello to both. I am the host of the Everything Coworking podcast, the CEO of Everything Coworking, and my mission is to help operators and community managers create coworking spaces that attract and retain their best members. So today we are here to talk about this week's podcast, which is around management agreements. And management agreements have never been so compelling. It didn't take a global pandemic to make them interesting, but they are certainly more compelling as we are coming out of a time that has shown us that lease agreements can be really risky. I will say, and if you're watching, throw me a comment or a wave. I can't see who's watching on my app until you put a comment in the comment field. So say hello. So I will defend leases for a minute. Leases, hey Ramsey, I'm going to give you a wave. Leases are often the easiest, most efficient way to get started with a co-working space. So if you are a new operator or you want to maximize profit, and you're not totally concerned about the risk, then a lease is still a good way to go. And if you're working with a really good broker who understands our business, they can help write in clauses that can help to protect in the future some of the things that we've experienced during this pandemic with not getting any rent relief when our businesses were essentially closed and now taking a long time to ramp up back to capacity. So management agreements. What is new with management agreements? So we've been talking about management agreements for a long time. There are not still a lot of operators who are doing them. We heard Jamie Hodari from Industrious was on the podcast a few episodes ago. That's all they do today. So there are operators out there who that's their business model. That's their go-to-market model. He said since 2018. So let's talk about try to stay organized here. I have some notes, which is why I'm looking down. So management agreements have traditionally been a little bit challenging to do because landlords, don't get involved in operations, so don't necessarily want to partner with an operating business. They're used to having a tenant that stays for 5 years, 7 years, sends them a rent check every month, and that's it. Easy, right? And ideally, that tenant is somebody who's been in business, who has proof that they've been a successful business operator, and they don't need to really worry. And if anything, happens like a global pandemic, they're still asking for that rent check. And it's a more traditional, simple model. And we've started to see some entrepreneurial landlords who are interested in co-working. And I would say before the pandemic, their interest generally stemmed from wanting to do something interesting with the building, understanding that offering flexibility is starting to be a lot more compelling to tenants and somewhat seeing the future. But there's still a lot of aversion to doing that because it's just more risky for them to get involved. Certainly, we see landlords that are smaller landlords and interested in running their own co-working space out of a building that they own. And so Matt Maurice was on the podcast last week and talked about that. So this is more about a landlord who might own multiple properties and is starting to think about how to get more flexible with their offerings and might be open to doing a management agreement. So what does a management agreement look like? Let me get back to why are landlords a little bit more open today. We're starting to see more entrepreneurial landlords, partly because they don't have a choice, right? So a lot of landlords are starting to understand that the traditional tenant has gone away from the office and may not come back. And we still don't really know to what extent are, traditional businesses going to leave the office and work their way out of their leases. Some of this we don't have visibility on because there are leases out there that aren't up for years, right? So we won't see that impact for some time, but some landlords are now, living with empty space and thinking, what am I going to do to fill this space? And if they are learning more about the option of offering flexibility, or they're seeing that trend where maybe they have businesses that are saying, look, we want less space and on a more flexible term, they're starting to say, well, I need to meet this market demand. How can I do this? And I think the important thing to know about landlords is oftentimes, unless there's someone like a Matt Maurice who was on last week, hey, Matt, they don't want to run an operational business, right? So they're in the business of managing real estate and making investments, but they don't run an operational business. And so they don't want to do that business on their own. And so they're looking for an operating partner. And this is where the opportunity for you comes in. I think the couple things that are changing, landlords are sort of forced to become more entrepreneurial and look for options that align with what tenants today want. The other thing that's starting to happen, although there's still folks really struggling with this, is banks being more willing to lend to a shorter term use. So in the hotel space, we've seen this forever, right? It happens in other industries, but for some reason in office space, it's always been long-term lease agreements are what banks will finance, right? So if you go to a bank and say, I'm going to do a co-working space and the model is month to month or even annual agreements, on offices, that feels risky to a bank. And so oftentimes a landlord can't get the build out funded because the bank doesn't like the short-term nature of those agreements. And so those have been hurdles that we've seen, and banks are still not lending as much in this environment. But what I hear from my network is that they think in the next 3 to 5 years, that approach to, refusing to lend on shorter term agreements will start to go away. And so getting financing for short-term rentals and memberships will be much easier. I mean, again, gyms do it, hotels do it. There are but banks are risk averse. And so when they're used to a 3-year lease, a 5-year lease, a 10-year lease, a 20-year lease, they don't like to hear 30 days, right? Is the commitment that feels risky to them. Now, Matt, who was on the podcast last week, said he had a great relationship with his lender. His lender, he educated the lender on the business model and was able to get financing to support his project. So it's possible and becoming more and more likely. And that's one of the things that is changing. So one of the most important things that Mike Abrams talked about on the podcast this week is the need to educate the landlord. And so when you find a landlord that's interested, that's open-minded, that's maybe a little bit more entrepreneurial, they may still be hesitant to tell you that they have no idea how you make money and how your business model works. And so just go in assuming that they know nothing, give them the 101, walk them through the business model, walk them through your pro forma. And if you are an experienced operator, walk them through the life cycle of the business, what it takes to ramp up outside of a global pandemic, of course, what the ramp up time looks like, how you sell through the ramp up time, what a product mix might look like, what a margin might look like, what the operational costs might look like. Those are all super important for the landlords to understand, because remember, they might manage a building, but they're not used to looking at operational businesses, understanding how they work and thinking about participating in them. So one of the other questions that I just had in my notes that I want to address is that people are always asking me for sample agreements. And we're going to talk about a little bit about how these are structured, because everyone wants to start with a template, which I totally get. And there really are no templates out there. And I think I only have theories on this. One of my theories is that the folks who have done management agreements have invested so much in making these happen that they're just not willing to share. So we'll get there, I think, but it's an expensive process to go through in terms of negotiating the terms and then creating an agreement, because this agreement is like a partnership, right? You have to think of all the what ifs. You have to think of what happens if we break up, what happens if the building is sold, what happens if we're not profitable, like all the what ifs you have to put into this operating agreement. And a lot of negotiating around how is this agreement going to be structured. And one of the other reasons there's no template is that every agreement is unique, because it really depends on what's important to the operator and what's important to the landlord, and can you make them match up. And before I go any further, I just want to circle back to a couple things. When you're looking, and the other thing that's really challenging still today, which Mike and I talk a lot about, is this idea of matchmaking, right? Like the landlord doesn't put a sign out front that says, I'm looking for a co-working operator. And so the co-working operator generally has to sort of network and poke around and try to talk with brokers and try to figure out how to get in front of landlords that are open-minded to this, that they might, talk with and find some common ground. So the matchmaking process is really challenging, but I would say if you get in front of a landlord, yes, NDAs, all those things, totally, Kim. So if you get in front of a landlord, one of the challenges that's still happening is that a landlord will spend a lot of your time getting educated on the business. So you want to ask a couple of questions up front. Don't go in feeling like they have all the power, because you have a lot of power, they have empty space. And so you want to make sure that they're not interested in doing it on their own. So they're not going to just use this process to educate their own team and then go operate. That's fairly rare because, like I said, most landlords don't have operational teams and they don't want to, but just make sure. And then make sure that they can get financing to support the build out. Because if they're going to just run into a complete roadblock with their bank and they know that now, it's one thing if they find that out later, but if they already know that now, you don't want to go through the process until they think that they can manage that. So just be careful about spending a lot of time going through this process and then there being no chance that it's going to work out. So try to feel out how serious they are. Make sure they're not trying to do it on their own, and make sure that they have funding. And so that kind of dives into, what does the structure typically look like? And if anybody has questions, please, like I said, on Facebook, I can't see unless you post a comment. Drop in a question. I wanted to have Mike come on. I didn't think about that until too late. So he's out touring a building today and said next week he will do a Q&A. So throw in questions. If I don't know the answer, then I will get Mike to address them. So generally how a management agreement is structured is the landlord would fund the build out, right? Because the landlord owns the asset. And this is sort of one of the upsides of doing a management agreement, is you don't have to come up with the capital to do the build out, which if you've opened a co-working space, can be significant. So there are trade-offs in the model, right? So the trade-offs generally are that you're not funding the build out, but there's less upside. So since you didn't take the risk of signing that lease, you didn't commit to that 5 years or 10 years to cover the cost of the build out with the landlord, you don't get all of the profit. So generally the landlord will fund the build out, but then, as Mike mentioned in the podcast, we'll look for some sort of skin in the game from the operator. So that may be some investment in the build out. It may be that the operator's funding the FF&E, which is another thing. Sometimes the landlords don't have a way to get the funding for furniture. That's not something they usually buy for tenants or for their building, right? So that can be helpful. FF&E would be furniture, screens in conference rooms, Wi-Fi, access points, etc. So you may fund those, and some of that is leasable. So if we're trying to reduce the amount of capital you put in up front, that can be positive. And then the landlord would then have a working capital fund, right? And so this is often why a landlord's going to want to have proof that you are a good operator and you know how to ramp up a business, because they want to know how much time it will take and what that operating working capital needs to look like in order to get the business to cash flow positive and generating a profit, right? So if you've opened 1 or 2 spaces in the past, you know what that process looks like. If you haven't, you likely completely wildly overestimate how quickly you can ramp up a space. And then you have to go back to the landlord and explain that you were wrong and overly optimistic. And they have the risk at that point. So it's not impossible to talk a landlord into doing a management agreement when you're entirely new, but likely they're going to want to see some sort of track record so that they know more of what to expect and they can sort of believe what you're selling. So working capital, so they're going to own the operating budget, right? There's going to be an account and you're going to pay for the coffee and the internet and all those things out of this account. And that account is going to pay for a management fee. So that's how you get paid month to month. Sometimes the management fee doesn't kick in until you've hit profitability, but oftentimes that management fee is covering your time through the entire project. And again, it's a fixed monthly fee. It's not going to be the upside that you're going to have over time when you are the one signing the lease and taking on the risk. So it's going to be an amount that makes sense for the time that you're putting in to market the space, to manage the team, to manage the operations, to do all the things, right? The landlord is not involved in any of that. You as the operator own the sales and marketing, the operations, the community building, all of the pieces. But that operating fund would pay for your staff and your management fee. And then when you hit profitability, that's where the negotiation really comes in, is oftentimes then you get to saying, okay, we're going to split the profit. But what does the split look like? And when does that split start to happen? So does the build out get paid for entirely before you start splitting profits? So the landlord's making back the cost of what they invested into the space. Or are you going to do some split, like 25% to the operator, 75% to the landlord until the build out is recovered, and then you split 50-50? There are so many ways to do this. And again, this depends on the operator that's coming to the table, how much experience you have, and really what the landlord is willing to do and how they're willing to structure that agreement, and if it works for you and if you can make that work for your model. So again, there's less upside, less monthly revenue and profit for you as an operator, but you're getting into this with no upfront capital expenses. And so it could allow you to expand more quickly. The challenge with management agreements is right now, again, the matchmaking piece, it's just hard to find in any given market what landlords are interested and open-minded, and then going through the process of working through that. I mean, a lease can take a very long time to get signed, right? For those of you who have a space, it can take a long time to work through that, depending on, the market and the building and the landlord. It can take even longer to do a management agreement because there's just so many more aspects to negotiate. And it's really like a partnership, like a marriage. You have to be really, really aligned and work through so many more details when you're operating partners. So, those are kind of the highlights I wanted to hit today. Any questions before we wrap up that you guys want to post? I see lots of friends. I'm waving on Instagram. Okay, I don't see any questions coming in. Oh, there we go. Hey, Amy. So the management fee is only paid. So you know what? Somebody mentioned that recently in a conversation. Sorry, Amy's. I'm getting fancy. So I'm using StreamYard. Those on Facebook can see the comment. So Amy says, clarification, the management fee is only paid until you're profitable, then you're just drawing on your portion of the profit. So typically, the structure that I like is and I've never done one, I just like it in theory, is the management fee is always paid, right? So you should never be working for free, right? Because there's so much that goes into operating the business. So the landlord's paying for the build out and the landlord owns the building. So that's really appealing, right? Because you don't get to take the walls and the electrical and the sprinklers with you when you have a lease. So the investment is the landlord, but you're running the space and you're doing the pre-launch, you're hiring the team, you're doing all of those things. So that management fee should be paid even pre-launch, the minute you start working on the business. Essentially, there's a monthly fee that generally is kind of related to the number of square feet, although it doesn't scale. So if you're running 100,000 square feet, it's not, $100,000 a month versus a 5,000 square foot space at $5,000 a month. There's a certain amount of time you're going to commit to running the space. And so you're getting paid for that. And then the next sort of decision point is, how does the profit share work, right? So in general, I think the best agreements give the operator upside, immediately, so that you're not incented to only do the minimum, right? If you're only working for your management fee, then do you really care if it's profitable? And so, most of us, Amy, I know you're going to give 110%, to anything, no matter what you do, but we want some profit share, I think, in good agreements right from the beginning, so that the operator is motivated to make sure that the space is optimized. So the question really is is the split 80-20? Building owner to operator, is it 50-50? So sometimes it'll be 80-20 in the favor of the building owner until the build out or some portion of the build out is paid for by the profit. And then once you get to that point, which could be years, right? That could be 3 years, that could be 5 years. Then the profit split becomes, say, 50-50, and that's really appealing to both sides at that point. So that's kind of how that would work. All right, I'm gonna take your comment off. Thanks for the question, Amy. Oh, anybody else have any questions before we wrap up? Awesome. Well, feel free to post questions in the comments. We're gonna do a live with Mike Abrams next week and dive in, and you can ask him. He's done several management agreements, has a lot of experience with the technical aspects. So would love to see you back here, same time, same place next week. Thanks, everyone.